Property investing is about you. So, who are you? When it comes to property investing, if you have a clearer understanding of the type of property investor you are, the type of risk profile you have, you can design and execute your investing strategy and your investing plans much clearer. Recently, we've had a whole range of clients come to us asking us questions that simply do not suit their own investing goals. They are seeing information out there, but they're unclear as to what they should really be asking. So what we've come up with here at Confidence Finance is our very own framework to help people understand what type of property investor they actually are. We're combining 10 years of experience, thousands of property investors, lending strategy and property strategy all together here to help come up with a framework to help you ask the right questions and help you execute your investing strategy with a little bit more clarity. We've come up with 3 different investor profile types. And what we found is the media and the noise and the investment property education that most people have steers towards questions and alignment that most people actually are not seeking. Most people do not want to be go, massive property investors. Most people are actually what I term as wealth investors. People who are looking to use their money to generate wealth and use their income and savings to go invest in property in a safe, sustainable manner. The conversations you have, the properties you buy, the lending strategies you have, it all changes depending on the type of investor you are. Curtis, how are you?
Yeah, going well. This is a good one to get into because it's a common conversation we have and something we do quite regularly is trying to help people get a feel for what their actual objectives are in property investing and to some extent be honest with themselves about that because, you get a lot of, new strategies or flavor of the month strategies that people want to talk about and want to try and implement. Yes. But you have to think about what you're really trying to get out of it in the long run and whether or not you actually want to go down that path.
Exactly.
So yeah, good one to unpack.
Exactly. I've tried to come up with a little bit of clarity, a checklist. Obviously, we don't really like to shoebox people into one or the other, and people can move from different investor groups. But we like to ask questions when we start working with somebody as to what they're thinking, what their goals are, what their risk profile is, and we use that information to help ascertain the type of lending and the type of properties they may be buying and the type of education that we can provide them. Someone who is a first home buyer does not need to go learn about trust lending and what SMSF lending is when you're 22 years old and you haven't bought your first home. That was literally a conversation that we had earlier today. Someone who's looking to purchase their first home, who never purchased a home before, had decided, hey, I want to get trust lending because they saw it online. Doesn't make any sense because they are misaligned in terms of the type of investor they are and the lending strategy that they're seeking. So by the end of this, I hope that we can provide some sort of clarity by going through these 3 distinctions that we have for people, and that clarity can help you make property decisions and financing decisions accordingly. So let's go through it.
And these are all good types of investors, I should say.
Yes.
So you're not trying to be one or the other. They're all good. You make all of these people have a lot of success. So you don't have to be like, you don't have to try and be something that you don't want to be.
Yeah, 100%. So the reason why this is happening more and more is because the conversation's dominated now by transaction-based buyers agents who, effectively promote people to go buy multiple properties. And because of that, people are a little bit confused because of the information that they're going and consuming. But most people are actually not in that boat. 80 to 90% of people in Australia, of property investors in Australia doing really good property investing are actually what we coin as wealth investors, as they are looking for a sustainable way to grow something on the side and to grow some wealth on the side and achieve financial freedom over time and have a bit of a nest egg from their property investing. That is what they're seeking to do. That's the majority of people in Australia, and it's really the majority of people that we work with, even if we have conversations with the other groups.
Yeah, and so wealth investors are really looking to take their savings, their capital that they've built up, and they don't want to hold it in a cash account. They're going, okay, that's too low risk to just hold it as cash or put it under my mattress.
Yes.
So I can see that there's the opportunity in property to take that money, invest it and grow some wealth. But they're not looking at the kind of more extreme or aggressive end of the spectrum. They're the type of investors that are looking at probably providing 20% deposits, using the larger banks, doing things in a way that gives them what I would say is the most like efficient finance. So not paying LMI, avoiding unnecessary fees, accessing the lowest rates they can, putting in potentially a little bit bigger deposits to do it.
Yep.
But having potentially a little bit of a smaller portfolio or a less aggressive portfolio, but having it set up in the most efficient way, and then potentially being in a bit more of a buy and hold scenario where, you let it play out over time. And that's what builds the wealth, basically a hell of a lot more than if you had have put your, that same cash under your mattress or in a term deposit.
Yeah, exactly. So the lending strategy here, so this is the green basket that we've got, the wealth investor. On a separate note, the reason why we're coming up with this is actually we have a sort of free course coming out very soon for property investors that takes you from the real beginning all the way to the end and everything that we've learned, which we'll cover in a different pod. But part of this course is part of this podcast that we're talking through today. One chapter of it is this specifically, where we talk about different investor types and working out what type of investor you are. And it goes back to my opening line, what type of property investor are you? This is the majority of people. This is the green investor, the wealth accumulator investor. They are seeking lending strategies behind their goals. So let's unpack it. What is their goal? Their goal is to invest in property and build wealth through property, and do it in a safe, sustainable, step-by-step, methodical manner.
Yep.
Doesn't have to be super, super fast, super, super quickly. It's when the time is right, when I feel like my balance sheet can afford it, when I feel like I am in an income excess position, when I feel like interest rates are low, I go and invest. That is the majority of Australians. That's how the majority of Australians come into property investing. We're coining that. That's the goal. That's the green investor, the wealth accumulator. That's the majority of Australians. It accounts for 80% of people, 80 to 90% when you look at the data, 80% probably for our purposes, but 80 to 90% of Australian property investors are in this boat. The type of lending that they do is, they generally provide 20% deposits because they can. But if you're younger to it, I would say you may have a smaller deposit too, because it's very hard to save up a 20% deposit. First home buyers that are going to be investors are often in this boat, where they're looking to buy an investment property, but they want to take advantage of the benefits associated with it. So quite often they're there. They are regularly looking for discussion around P&I or interest-only loans. They're not just clear on, it's an investment property, must be interest-only. It isn't a absolute clear-cut position. It is a conversation that needs to be had as to whether it should be interest-only or P&I, because principal and interest is a powerful way to build equity into your portfolio, because it starts to bring your debt levels down while your property values start to increase. You have both working for you. So a lot of these green investors actually prefer P&I, but they think they need interest only because it's what is common practice out there. But that is one of the key differential points and one of the key conversation points that we have with people in these circumstances. Is interest only necessarily better? Because it costs more over an extended period of time, and it costs more when you're initially getting a loan because banks charge premiums. Do you really want it? Do you really need it? Or do you want to be growing equity via loan pay downs as well, because it suits your goals? They are sticking to mainstream lenders. I wouldn't say major banks, but mainstream lenders. So lenders, probably 15 types of lenders out there, maybe 15
lenders
to 20.
that offer competitive rates, basically. So it doesn't have to be big four, but lenders that are competitive on rate.
Exactly. So good lenders that they're not looking to go to non-banks. They're not looking for crazy risk with their funding structure. They want to stick with lenders that are secure, sustainable, and going to provide them what they need in the medium, long term. So that's their lender selection. That bit probably isn't that important to these property investors. They're not really caring where their credit is coming from. They just want good rates and things like that. So we often have conversations around debt recycling with them. So people who own their own home already and are seeking to invest and use their savings to pay down their loan and then re-borrow it to go purchase an investment property to ensure that their debt mix is correct. So we often have conversations around debt recycling for these wealth-based investors. And that's by and large the financing summary. And that's the conversations that we need to have with them. It doesn't need to be a really, really detailed conversation about every lending option there is under the sun. Sure, we have access to that, but they don't necessarily need to know it because it's just information that is completely pointless to them.
Yeah, and I think how I would describe it is kind of keep it simple, keep it efficient.
Yes.
That's, the wealth investor benefits from an efficient finance setup.
Yep.
Where you have your rates as low as you can, and you're not chasing a highly leveraged or highly risky position. You want to have the most efficient setup possible to help you build wealth over that longer period of time.
Yes. Great summary there. Now, let's break it down into property selection. So this is expanding the horizon a little bit, but goes into that course that I talked about. Property selection. So these type of investors are typically looking at major capitals and major regionals only. So they're not necessarily looking at places.
Not highly speculative areas.
Yeah, exactly. So they'll rule population centers below 10,000 people out, being like, look, just too much volatility. I don't need that.
Yep.
Why? It's too much risk. Happy excluding it. They often buy houses, not apartments, or they buy townhouses if affordability is what drives them there. So that's the type of property that they're generally looking at.
Maybe if they're a little bit cash flow conscious, maybe they're looking at something that you can have a granny flat or something like that. But, people throw around the term, blue chip asset a lot, but that's kind of the types of, relatively safe property in larger metropolitan locations that have good population base, diverse economy, like you say, the big capitals, big regional towns, and probably I would say in our experience, they often start their portfolio in a location that they've got some immediate familiarity with as well. So, the first investment, might be in the same city that they live in, or somewhere that they've got some immediate experience with.
Part of the education that we're providing here is actually about expanding their horizon and looking at targeting short-term growth. So this is one of the most wonderful elements of property investing in 2024. All the wonderful information out there actually helps suburb selection a lot. All the tools out there help suburb selection a lot. All the knowledge helps you work out that getting short-term growth is actually a really powerful way to build your property portfolio rather than waiting 5-10 years for it. And jumping on rising tides and finding rising tides is entirely predictable, systemizable, and repeatable. So you can execute these sort of data strategies to go and find areas that it can do really well. So this is often what buyer's agents do. And a lot of wealth investors do use buyer's agents or courses to help them work out where to buy. And they are picking areas nowadays that achieve that short-term growth and are often buying houses with land component that allows for greater longer-term growth too. So that is the new flavor, the 2024 flavor of being a wealth investor today. And that's probably a little bit different to 10 years ago where it would have been more, hey, without access to all this knowledge and information, I would have just stuck to what I know. But now that can be expanded out to other areas. So wealth investors could easily be purchasing in Perth like last year, the year before, because they're following the data signals. And that says, hey, look, it makes sense to buy in Perth. Even if it is a bit unfamiliar, I might not want crazy risk here, but Perth's a city with over 1.5 million people that is risk managed, but it is all the way over there. That's okay.
And I think one of the things, that we strongly believe is there's not really a reason to sacrifice short-term growth. Like, over a 10, 20-year period, your property might have gone, doubled or quadrupled or something like that. And it might feel like it's gone up, a relatively steady amount. But in reality, it goes through extended periods of being relatively flat and then, short periods where you're getting a pretty significant amount of price growth. So, I think from an investing strategy perspective, even as a wealth investor, there's no real reason why you wouldn't be chasing an asset that has some really, really good short-term capital growth prospects.
Yeah, for sure. I want to go through a little client story here. So one of our clients, he started buying properties in 2018, 2019, about 5 years ago. And he bought a handful of them. He bought 4 or 5 of them over an 18-month period. And he was on a really good income. He had almost paid off his own home, but he re-leveraged all the equity there in their own home to fund his deposits and then got 100% loans effectively on every investment property he purchased. Him and his partner, from memory, they made close to $350K in household income. So very, very good incomes. Just a family living out in the hills in Sydney. doing really, really well for themselves. He bought a whole bunch of investment properties, used buyer's agents for some of them, and did some of them himself all across the country. A couple in Adelaide, a couple in Perth, and one or two in Brisbane from memory. I don't really remember the exact locations, but he bought really, really well. And what he's done with that is he had some owner-occupier debt left, around 300,000-400,000, and he's just sold one of those properties that he bought 3 or 4 years ago. He sold it for double what he bought it for, or 90% more than what he bought it for in 5 years, did really, really well, and has just paid off his own home completely, and now has no deductible debt. Through all of this, yes, he bought 3, 4, 5, 6 properties, but he still remained what I call a wealth investor because we had conversations, we had education around other lending opportunities, but it became less of a keep it simple and efficient and more down the it's riskier, but you can go down this risk path. We can manage all your risk, but he still chose to stick to the sustainable manner, and he's achieved outstanding results for him and his lifestyle and everything that he wanted. And him and his partner have decided, hey, I want to take one day off a week, spend more time with my kids, because really our financial position is so much better from making these decisions than it was in the absence of it. Had he just simply continued to pay down his loan, he probably would have eventually paid off his property in and around now, maybe a little bit later. But now he has that exact same position, but he owns 4 other investment properties that are sitting
his lifestyle, yeah.
Yeah, they fund his lifestyle, and that are sitting at 50, 60% LTVs now because they've increased in value substantially through that period. So he's sitting on a lot more wealth that he can liquidate at some point if he wanted to, and put into an income asset at some point. He's not at that point yet. He's in his early 40s, but it's just a story of how most investors actually are wealth investors, and they don't need to complicate it with extreme structures if they don't need it. And they may need to know about it, they may want to talk about it, they may want to know what the options are, but you can actually buy multiple investment properties and stick to this wealth investor principle of keep it simple. I want to grow wealth. I want to build a nest egg for myself, but I want to keep it sustainable and safe. This could really, really work for you, and you can achieve outstanding results by being this type of investor. And it's the majority of everyone.
Yeah, and you don't need to pursue, like you say, overtly convoluted or difficult financing arrangements.
The next group,
the opportunity investors.
The opportunity investors, I like it.
Yeah, so I would say these are the people that kind of view their income stream as, a way to leverage opportunities. So they're probably less, I would say, mindset-wise, they're less focused on, say, building wealth, and they're more focused on, I see an opportunity in front of me or that has come up that I think can make money or will, generate me a return, and I want to find a way to get it done, basically.
Sounds like a wealth builder to me. Sounds like someone who's really, really wants to accelerate wealth creation. Is that?
Yes, accelerate, and they're more, I would say, focused on, they're like, oh, this opportunity's come up, like I want to get it done, as opposed to someone who's like, hey, I want to invest for the long run, and I feel comfortable that I'm in a position to do it now. So, I'm thinking I'm going to make a purchase in the next 3 months kind of thing.
Yep.
I would expect the opportunity investor is someone that my phone is going to ring and they're going to be like, hey, I've had a chat to someone, or I've seen this property, or this thing has come across my desk one way or another, and I want to explore a way that you can help me get this over the line.
Yep. We get that a lot. That is a situation that we know all too well. Your weekend phone calls pop up every so often from someone being like, hey, I saw another one. Can I get this deal done? That is a common scenario that we see. So the financing framework for this type of investor, the goal of this person is obviously wealth creation. They're just willing to take more risk to do it, to be a little bit more aggressive, and they want to get there a bit faster, I would say. They want to help accelerate that and make some actions and be far more active in that process to help accelerate the process of financial freedom, which is often the goal of most of the property investors that we speak to. So the financing structures here are often around non-banks and expanding your borrowing envelope beyond what most banks are willing to offer. So most banks are willing to offer this much, and I need to get this much plus 10, 20, 30, 40, 50, 100, 200, 300%. These are the type of conversations that we have with these type of investors. So that's the financing, borrowing power sort of conversations that we have. It's about strategies to increase your borrowing power. I've done a whole range of podcasts on this. We talk about a whole range of options, SMSF lending, company lending, trust lending.
Non-banks,
non-banks.
Aggressive lenders. Yep.
Exactly. So we've got a whole range of education and podcasts out there that really, really very, very suitable for this group of people who want to expand their portfolio. They almost always want interest only, and it does suit them. They should be on interest only terms. And
to manage cash flow. Yep.
Yeah, refreshing their interest only terms and managing the potential for principal and interest as part of their risk buffer frameworks.
Yep.
But quite often they're using these non-banks. So, the Peppers, the Liberties, the First Max, the Resimax, all these lenders that offer more money than mainstream lenders, they're often using these non-banks to go and get there, or they're using entities, or they're using their SMSF. That is quite often the structures that they are using to continue to invest in property. That's the main financing type that they as investors have. And the conversations that we have with these investors, often planning around their future. If we identify them as this type of investor, it's having these conversations up front and setting up their financing structures at the outset or as early as possible to align with their goals of them being this type of investor and being able to take advantage of opportunity when it arises rather than just investing when it suits them.
Yeah, I think once you kind of move from potentially a wealth investor to an opportunity investor, the level of forward planning and early planning you need to do on the finance side is a lot higher.
Yes.
Because a wealth investor, they are probably more comfortable with that. When the opportunity suits them and the numbers make sense, they'll do something. And if the numbers don't make sense or the financing isn't looking that good or attractive, then you just sit tight and wait until it does. For the opportunity investor, that's not so much of an acceptable outcome. You've got to find a way to get it done. So the planning work and setting up the right financing structures at the start becomes very important for them, because that is what kind of gives you the borrowing power payoff over the journey. If you use conservative lenders and do things in your personal name and chew up your borrowing power, you can cap yourself out. So these lenders might need to make some sacrifices early in order to facilitate their more aggressive kind of growth journey.
Exactly. So in terms of property selection, quite often they are still buy and hold investors, but they open up their spectrum a little bit because they're opportunity investors. They may buy apartments when apartments are undervalued. Brisbane apartments are up near 40, 50% in the last year or two alone. So they would be open-minded to apartments because the numbers say apartments are going to do really well. So they are open-minded to it. They don't set boxes around their property framework as much. They're open to smaller population centers. They still often have buy and hold investment strategies, but they are more willing to pick other sort of approaches that help them buy properties that rise in value and are open to buying where opportunity sits. So that's one thing about them. They are quite happy chasing early boom markets as well. So they don't need to be buying in an area that's already flying. They are happy investing a little bit early, taking on a little bit more risk in that framework, but getting the upside of that. So they open up their property. So basically, the short difference between the wealth investor and this type of investor is they're opening up further options and taking a little bit more risk with the frameworks they put in place for their property investing, but still have by and large, the same principles of let's buy in areas that are going to do well. I want to buy for capital growth. I want decent cash flow. I want all these things, but I'm opening up my pool of options a little bit wider than a narrow framework.
Yeah. So the difference would be, a wealth investor, there might be a purchase opportunity, let's say a more regional area, and you might need to go to an aggressive lender to get the finance to work. And a wealth investor might look at those two factors and be like, that's not, I'm not really interested in doing that. Whereas an opportunity investor might be running the numbers and there might be a really good yield, or there might be something associated with that market that they're really interested in.
Yes.
And they're like, you know what? Like, that's inside my risk appetite. Like, I'm happy to roll the dice on that. Like, let's do it.
Yeah, let's go for it. Their timing as well with their purchases. They always have the attitude, I want to buy whenever I can. It's frameworked around the opportunity that comes around. And also they're always kind of looking. They're always like, can I buy now? Can I buy now? Can I buy now? And when you say, hey, lending might not let you, they're still looking and being like, I want to buy when I can. So it's people with the equity that have the ability to do it and with the general mindset of, I want to always be on the lookout for purchasing property. So these are fairly active property people. As a little signal, what type of property investor are you? If you've been on Real Estate Domain in the last week, but you haven't bought a property in the last 6 months, and you can say yes to that question pretty much every week, you're this type of investor. You're always looking. You're an opportunity investor. That is the type of person you probably are. You're always on the lookout. That helps you clarify whether you're this type of investor or not. I'm going to add in a little client story again of a different position. So someone very, very similar to the first story also bought, I think he bought 6 or 7 though. He bought a whole bunch of properties. They were much cheaper, but he bought a whole bunch of properties in areas that when I saw these contract of sales 5 years ago, I was like, how are you picking these areas? It seems so random. Like Grafton was one of them. I think Townsville was one of them at the time. And, I know we did a podcast about it, but Townsville 5 years ago for a Sydney property investor.
Was
bit
middle of nowhere, yeah.
Yeah, a bit like we haven't seen too much of this. Grafton, a whole bunch of regional areas. He was buying small contract prices, much, much smaller investments. He was on a much lower income, him and his family, significantly lower income, but he was continually looking to expand his portfolio at the time, and he bought a whole range of investments, went to non-banks and expanded his borrowing power out. And he also has done exceptionally well, very, very well for his own income level because he bought at a really good time. Assets have done really, really well over the past 5, 6, 7 years, and he has benefited from that. And that is a different sort of scenario where someone has taken on more risk because they're on lower income and wanted to achieve the same results. So lower income earners, if you really want to push the boat out there, you sometimes could be pushed into this sort of lending strategy and investing strategy to get the actual results that you want.
Do you want to go our third category, which this is probably the one everyone wants to talk about because the further you push it, the more interesting and / exciting it gets. Yes. But it is in reality, a very, very, very small percentage of investors.
Yeah, this is 1 to 2% of investors, the super advanced investors, those that are just go whenever they can. They're just looking to buy all the time and find any opportunity they can.
We don't even really have a name for them. We were brainstorming. It's like the
go.
The manic investors, the obsessed investors, the crazy investors.
Just going to call it like the people like me. I am a little bit like that. I love property, and part of that love is, always finding opportunities and looking for opportunities and looking to access credit whenever I can to actually build my portfolio. That is the way I think. It had started from my first property investment where I had no money and I just found a way to buy and couldn't afford lunch, and you were buying me lunch for that week to just actually get through. Had $15 left or $16 left. I still remember seeing the ATM slip where I wanted to take $20 out and I couldn't get it out because I only had $16 there. So, that is people who put themselves in positions like this are clearly go manic. I want to use any form of capital I can to go invest in property. These sort of people have very different lending structures, have very different conversations. They almost always purchase in entities or are looking to invest in entities to continue growing their portfolio. So trust lending, company lending is a common part of what they do. They have the attitude of get me as much money as possible all the time. One thing that I find is commonality with these people is they don't like cash. They just don't want it. Like, sounds absolutely crazy. They don't want to pay off their loan. Like, the general education you get there, get a loan, pay it off as quickly as possible. That's how you make money. That's the financial education we all get. These people know that is, not true. That is not how anyone who's become wealthy actually gets wealthy. These people want to become wealthy, so they are like, cash is trash. I want to go use my cash as an opportunity to buy something else. That is how they view cash. The attitude that they have towards money, the assets are what is going to create wealth, and they need debt to go and get those assets, and the cash is simply an opportunity to turn, it's a tool to get an asset that they want. So that is the sort of attitude that these sort of aggressive investors have. I got a little WhatsApp message from one of my investor clients like this as of right now, and he was fretting. He's like, I'm sitting on cash. It's like really, really stressing me out. And he's like, Rita, help me find an opportunity. I was just like, That is definitely the mindset and the type of conversation that you have. When you flip it to the beginning side, a lot of people feel really comfortable with cash. It's really a real powerful tool to manage, offset balances and pay off your loans, etc. That's the majority of people in that boat. This is the complete opposite side of the spectrum, the crazy ones.
Yeah, just want to hold assets. And like you said, on the lending side of things, essentially open to any lending solution that allows them to continue accessing credit.
Pretty much.
So
private, even.
Private lenders.
We don't do so much of that, but private,
Yeah. You purchase in companies, purchase in trusts, you whatever it takes, even if it's, drives up your cost of debt, not that much of a concern. They believe in the return of the asset that they're purchasing. So they're just looking for access to debt.
Yes.
At almost, maybe not quite any cost, but, for a lot of people at almost any cost. If they can access it, they will find a way to get a return that beats it. That's the kind of attitude they have, which is high risk, high reward.
Yeah, exactly. So that broadly is the third group. It's a super advanced group. Now, this is the reason why I mentioned this is so many of our starting point conversations, the conversation that I said about, we had someone in the morning, he's talking as if he's this sort of person, but he hasn't bought a property at all yet. And he's a first home buyer looking to buy his first home to live in. And it's like, you don't need a lot of this. Yes, have conversations, talk about it. Let's see if you actually identify as someone who wants to go and become this and design your investing around this, because there are consequences. You start buying in trusts and entities, you're going to have a paperwork nightmare. You're going to slow down your lending. It's going to be a little bit more difficult, and you lose the simplicity that keeps you going and helps you build your portfolio in a safe, sustainable manner. This is a little bit riskier, but with a little bit of education, knowledge, and experience, you can kind of feel more comfortable taking on these risks. So it isn't necessarily good to be in this boat either. So this is a group of investors, a much, much smaller group, represents 1%, 2%, 3% of Australians. Doesn't necessarily mean you want to be there. It's not necessarily even a success benchmark at all. It's just that's the way they think. They're often looking for value add strategies as well. So the type of properties that they're buying, they're often buying the worst house in the best street and trying to identify, how can I make money out of this property deal? They're often looking for shorter term holds. So they're not looking for 10, 20, 30 year holding periods. They're often looking for 2, 3, 4, 5 year holding periods in terms of, I want to get in, I want to get out. They're more comfortable selling property through that process, while groups 1 and 2 often don't sell properties. In most of the stories that we have there, they haven't sold, or they've only sold one out of their total portfolio. And the timing of when they buy, it's pretty much always, or whenever they can, they're always looking to buy.
Yeah. And I would kind of describe it as inefficient. It's inefficient in terms of finance, it's complicated, it's time consuming, it's inefficient in terms of their time. This takes up, the majority of,
for sure.
If you have a job, in reality, your mind is focused on how you're managing your investments.
Yes.
So this is not a clean, efficient, people aren't investing like this and, having a set and forget kind of scenario. They are managing their finances, their investment portfolio on a day-to-day, hour-by-hour basis in some cases, if that makes sense.
Hour-by-hour is probably for the stock version, for people who do stocks in this or manage, or those crazy traders. It's a version of this.
You're thinking about what you want out of your investment portfolio and your investment journey. This is not like I say, it's inefficient. It doesn't mean it's not high profit and high reward potentially, but it's not something that you can do easily. Doesn't mean it can't be done, but it's not an easy path of least resistance kind of way to roll.
The reason why I know I'm this type of investor, Kurt, I can tell you about my day so far. So this morning I woke up, the first app I opened was Domain. The next app I opened was commercial real estate. I don't own any commercial property. I just wanted to take a look. I was looking for development land in New South Wales and in Queensland, just out of interest. Last night, I was doing the same thing, talking to other investors who are in this sort of boat. These sort of people are addicts. They just want to keep buying. I'm on Property Chat, which is a property forum. Many of you are on that forum. If you're there active, you are probably one of these investors, because you're there talking about property all the time. And quite often, if you're talking about property, you're thinking about it and transacting on it rather than just reading, and that's a bit weird. Some people do that. But most of the time, it is people with active strategies looking to make money through property, and they're using property as their vehicle for their wealth creation goals. Across the board, each of these goals are the same. Wealth creation. It's just the frameworks around that wealth creation objective is different. So it goes back to our initial starting point. Who are you, and what conversations should we be having with you? So we've created this checklist, which I'll put in the show notes below, where you can go access this checklist yourself and create your own sort of position and ask yourself a few questions that we'll even put in the checklist for you to help work out where you are, because it will help you design your lending plans, your lending strategies, your investing strategies, and it will help you get clarity on what to look for and leverage what other people are doing. One of the best things about our property story and our property experience is all the stories and all the experience we've picked up from all the people we have interacted with. It is absolutely the favorite part of my job. It's the favorite part of my last decade. And that is just condensedly summarized into 1 or 2 pager to a little checklist to help you work out what you are from everyone else's experiences, and me just digesting it for you and putting it in a simple format for you.
Yeah, and I would say that, in our experience, the happiest and the most fulfilled investors are the ones that manage to get what type of investor they are and how they actually go about their investing. We've seen a lot of people that push it too far for what they're comfortable with, over leverage, have to deleverage, stresses them out. They're not up for that. Whereas, manic investor is probably like, hey, that's just part of the roller coaster.
Yeah, they like manic.
Yeah, what, that's how we roll today. Tomorrow's a different problem kind of thing. So you don't have to push it. You don't have to take it to a level that you're not comfortable with. And by the same token, someone that's a bit more obsessed, they're not going to be a happy or fulfilled investor sitting there on a buy and hold strategy, twiddling their fingers. So you really want to align this with how you want to invest. Yeah.
Love it. The happy investor, that's the secret. Follow this little checklist to become the happy investor and work out where you stand, work out what type of property investor are you. We're just trying to help provide you some clarity around that.